Hello, good afternoon. You've tuned into CNBC-TV18. You're watching Your Stocks with me, Vinny Modiwala. I'm coming in from the Mumbai studio. Quick look at what the market is doing. Gave up all those morning gains that we had seen coming in. At one point of time, it did move to the red territory as well. As of now, just back to the green. So it's flip-flopping between the red and the green in the last half an hour is what we're seeing for the trading session. So Nifty is below the 23,200 mark. Keep an eye out on where that is headed. Similarly, sensex also is off the day's highest point and trading almost between the red and the green. Not much of an excitement that's coming in for the benchmark indices. Sensex still a bit more on the positive side as of now, holding on to 0.1% of gain. Let's pull up what the broader markets are doing as well. The Nifty mid and small cap, they were also off the day's highest point, but still are managing to outperform those benchmark indices. So keeping an eye out on that. Just a few names that I want to highlight in terms of the top drags that are coming in for the Nifty 50 today are mainly for the banking side. So Axis Bank, ICICI Bank and HDFC Bank are among the top drags. And other than that, we have Bajaj Finance and M&M that are among the top losers and top drags coming in for the Nifty 50. So surely keeping an eye out on that. But on that note, let's get started with the show for today. And this is a show where we solve all your stock-related queries. Our experts for today, we have Somil Mehta, Head of Alternative Research and Capital Market Strategy at Mirae Asset Sharekhan, as well as Sharad Avasthi, Head of Research at PCG at SMIFS, joining in with us on the show this afternoon. Good afternoon, and thank you so much, gentlemen, for joining in with us on the show. And, let's get started with the first query for today quickly then. We have the first query coming in is on two stocks today. We have Mushir Sheikh, who's writing to us from Pune. He's holding 375 shares of NMDC. This is at a price of 88.75, so making a loss here because NMDC currently is trading at 63 rupees. Also, he's holding 50 shares of Tata Motors at a price of 942 rupees per share. So that also has seen a fall specifically in these recent months coming in. He wants to know whether he could continue to hold both these stocks or look to sell them at the current levels. Let me start with you, Sharad. Good afternoon.
Yeah, good afternoon. I think NMDC, the valuations are attractive at the current levels. The long-term plan is to substantially expand the mining output, and I don't think they would face any kind of big troubles there. But the only flip side could be, the recent regulatory overhang on mining, which is roughly what on an industry level, it's probably somewhere around 2 lakh crores to be spread over 10 years. And then the state directives also coming in. So that's an overhang on NMDC. But I think at 7-8 times, most probably most of the negatives are already priced in. So I think we can continue to hold, hoping to see some recovery there if he's a long-term investor. But I think 1 or 2 years might be a tough time to get money out of NMDC, considering the China overhang also. But if you extend your horizon to say 4 to 5 years, when the fresh mining capacities also start contributing to the top line, bottom line, I think then NMDC could be a decent bet. And since the valuations are offering you a margin of safety, I think continue to hold, but extend your horizon to 4 to 5 years, maybe 1 to 2 years, it would be very hard to find profits out of this because of particularly the overhang on the mining issue. On Tata Motors, I think the JLR turnaround has worked very well for them on the domestic side for the first time in a lot of years. Maybe Tata passenger vehicles are finding traction. Commercial vehicles, I think, will continue to do well with the type of growth we are talking about in terms of reducing logistic costs, improving highways, the advent of EVs. I think all this should work out very well for Tata. And in valuation terms also, I think within the auto stock, four-wheeler stock, this is the cheapest available to you, obviously, because most of the earnings right now are contributed from JLR. But I think Tata Motors is something because of the PV and CV cycle being better. There could be more weightage on the domestic numbers, particularly based on the EV side also. So I think conservatively, if it trades at around, say, 15, 16 times, I think you should continue to hold for a target of somewhere around 1,050 on Tata Motors.
Okay, that's a view coming in on the fundamental side as well. But Somil, good afternoon and thank you so much. I think this is the first time you're joining in with us. So thank you so much for joining in with us on the show. Tata Motors, NMTC, what's your view? And specifically, when I'm looking at Tata Motors also, last 6 months, it's seen almost 25% fall. So, how does both this shape up in terms of technicals? Does it merit, actually averaging something like a Tata Motors or NMTC? Or would you suggest maybe selling the stock right now for the viewer?
Thank you so much for inviting me on the show. Tata Motors, I generally don't believe in averaging out on the losing side. Tata Motors is a good stock. It's a long-term story, very good, but in the medium term and in the short term, the trend is down. It is going down, and the levels in the short term, I would say, would be 693 is the support, and the next support is 619. So still a long way to go. On the upside, I think the resistance is 819, 820. Low top, low bottom formation. We may see a bounce back, but I don't see a medium term trend to change very soon, because the higher time frame momentum indicators have gone into sell. So I think I would see the stock close to around 620 levels for sure in next 20 in the medium term outlook. And in NMDC,
Yes, Somil.
NMDC is the same thing. NMDC is the same thing. A big head and shoulder pattern has broken down, and I think in the short term, medium term, both negative. I'm looking at least 53 levels for NMDC in the short to medium term outlook. On the upside, I think the resistance would be around 65 and 68.
Okay, those are the levels that you should be keeping an eye out on both the stocks. But let's move on to the next query. We have Gundeep Singh, who's writing to us from Punjab, and he's holding 200 shares of Sagility India at a price of 54 rupees, while 25 shares of Zomato at a price of 275 rupees. He's a long-term investor and wants to know whether he should continue to hold this or maybe look to sell the stock. What is your view coming in on this, Sharad?
Yeah, so I think Sagility, he can continue to hold. They cater to the healthcare segment, US healthcare particularly. Growth rates have been decent. Even the industry would grow at a very decent clip for the next few years at least. For Sagility also, you can expect, the top line to grow around 13-14%. And the bottom line would grow around 30% CAGR over the next 2 years, 26-27. So based on that, I think the only risk you could look at is basically a client concentration risk which they have on the books, which I believe most of the recent IPOs, smaller companies have that problem on their board. So I think that's the only risk that we can see. And obviously, being a tech-oriented thing, tech disruption is another risk that you could look at. But other than that, I don't think there's much risk on it. And considering the type of growth, I think getting 30x kind of multiples would not be very difficult for a company like Sagility. So hold on to it for a target of around 60 rupees. I think that's something possible. And Zomato, we think that probably at 8.5, 9 times 1 year forward, I don't think much is left on the table, EV to sales basically. So I don't think Zomato has much left on the table. And as we have been seeing, there are a lot of incumbents that are trying to come into the market. So I think if you're getting a Swiggy at maybe 6 times 1 year forward EV to sales, I think that's a better idea to switch into. So rather than Zomato, I would be happier buying into a Swiggy just because of the valuation comfort, nothing else. If you want to stay within the same space, and I think competition is something that will keep happening. So most probably the type of re-rating we have seen on the back of Blinkit, etc. Maybe Swiggy would repeat it better rather than Zomato getting re-rated from here.
Okay, let's move on to the next query. We have Namrata Rao, who's writing to us from Tamil Nadu. He's holding 200 shares of Bharat Electronics at a price of 250 rupees. They want to know whether they should continue to hold this as well, or what is the future prospect of this one. What is the view coming in on this stock, Bharat Electronics, from your side, Somil?
Bharat Electronics, I think I'm long-term I'm bullish on Bharat Electronics, because it has been in the consolidation phase since the start of 2024, I think, and it's been consolidating in a broad range. The higher time frame momentum indicators are still oversold now. So I'm looking at a short-term correction, definitely till 240, 230 levels, but in the medium term to long term outlook, it's looking really nice. Once we get a positive monthly close around 230, 240 levels, I think that will be the right time to buy the stock for a medium term outlook. But in the very short term, the resistance would be around 273, 275, and 240, 230 would be the target in the very short term.
Okay, keep an eye out on those levels over there for Bharat Electronics. But on that note, we're going to slip into a very short break. But after the break, we'll come back with a special segment, The Growth Code, an initiative by Grow and CNBC TV18, where we will answer and address the viewer questions on how to navigate the market and make informed trading decisions. So stay tuned in. Welcome back, and it's time now to focus on the Growth Code, a special initiative by Grow and CNBC TV18. Whether you are new to trading or a seasoned professional, our goal is to provide you with actionable insights and strategies to navigate the market and make informed trading decisions. We still have with us our experts for today, Somil Mehta of Mirae Asset Sharekhan, as well as Sharad Avasthi of SMIFS. Thank you, gentlemen, for waiting by with us. Now, let's start with this segment's first query for today. We have Riju Prasad, who's writing to us from Mumbai, and she's saying that she has heard stories about people doubling their money in just a few months in the market. She's asking if that is even possible actually in the equity market, and what should she be doing with such suggestions that come in. Somil, I beg your pardon. Let me take it across to you first.
Doubling the money in a few months is not realistic at all. I think it is possible in a very rare case where you have a very high risk and a very high reward scenario. But I think that investing and having a discipline with a plan, having a consistent return of 12 to 15% is achievable, but doubling the money in few months is definitely not realistic.
Absolutely, it's not a reality. And Sharad, your view coming in on this query, what would you suggest to the viewer?
Yeah, I think occasionally, as Somil rightly said, that once in a while you can have that kind of thing that maybe you buy something and it just goes up haphazardly. But obviously, you have to understand a very simple logic in the markets that higher the risk, higher the return. It's as simple as that. This kind of returns, I think on a long-term sustainable, scalable basis is not problem. Once in a while, luck and everything, all the stars align and you get that's a different thing. But regularly, I don't think that's a possibility.
It's not a regular phenomena that will happen in the market and that one could be watching out for. But long term, yes, maybe it's possible. In the long term, you're holding a good stock, then you could see maybe doubling your money as well. But let's move on to the next query. We have Simran Singh, who's writing to us from Noida. Now, she's asking whether it is reasonable to expect 20 to 30% growth and return every year if she invests in stocks. Sharad, let me take this across to you first.
No, I think you can't expect linear kind of numbers from the stock market. By virtue of it, it's investing in a business. A business goes through cycles of highs and troughs. So I think it's not reasonable to expect 20 to 30% every year. But yeah, over a period of time, you could expect, connected to GDP growth. So ideally, as Somil rightly said in the earlier question, 12 to 15% is what you should expect on an annualized basis. That is if you average it out over a larger period of time. But point to point expecting every year to give you 20 to 30%, I think that's not the way you should look at it. And a larger alpha, maybe 12 to 15%, you might have 4-5% alpha because you have invested in mid caps, small caps, because there the alpha is better over the longer term. But linear relationship, you can't expect year to year, point to point kind of returns from the equity markets. They will be a bit haphazard, not linear in nature. And expectation, if large caps, it's 12 to 15%, mid caps, small caps, maybe you have a 3 to 5% alpha above that.
Okay. Somil, I believe you also concur with the view, right?
Absolutely. It'll be extremely challenging to have consistent return of 20 to 30%. It can be like a few years up and a few years would be negative as well. So overall, if you calculate like 5 years time frame, then you can probably get 12 to 15% achievable in annually. That too annually is not it won't be possible to have 20-30% every year annually.
Right. This next query we have is coming in from Shweta Tiwari, who's writing to us from Pune. She's asking how she can manage her expectations when everyone is boasting about making huge profits around us and around her. So normally, how do you handle such a situation then? Because I think this is that FOMO feeling we always talk about. Somil?
That's the feeling for us as well, like amongst us as well. But overall, I think just focus on your own plan. You should have your own financial goals. You should have your plans. Keep updating your knowledge. Keep reading research reports so that you can update your current knowledge about the stocks, equities, commodities, etc., etc. So yeah, disciplined approach is definitely better for the long-term investing.
Absolutely. Disciplined approach is very important, Shweta. So keep an eye out on that and always be set your goals and keep yourself disciplined on that. But Sharad, your view also coming in on this one.
Yeah, I think largely similar. Everything works in a different time frame. Like every individual cannot excel at the same time. Different people excel at different times. Similar is the story for stocks. So not every business will go through the same cycle. Some businesses will go through a down cycle. Some might be good. So stick to a process. Do not compare across businesses, across companies, and think that everything needs to go up in the same fashion. And decide on your process and stick to it. It's about what you are comfortable with, whether you are a trader, investor, what kind of investor or trader, and design a process around it and stick to it rather than haphazardly switching between processes and styles and ultimately, maybe on average losing money across the board.
Okay, this next query we have is coming from Rahul Sharma, who's writing to us from Pune. Now, he's saying that he keeps hearing about stock tips and, words coming in like sure short gains. And I think this does a lot of WhatsApp forwards or Telegram is where you see all these words coming in. He's adding that should he trust them or they're too good to be true? How do you judge this situation, Sharad?
Yeah, I think certainly too good to be true. And I think you have to understand the basic underlying is that you are investing in a business. And every business has n number of variables which are internal and external, both to the company, which we call macro and micro risks. So I think nothing can be sure shot in a business. There are probabilities, but nothing is sure shot. And certainly, if someone is sending to you free of cost on a WhatsApp, I think he or she would do better making money out of it rather than telling the idea to you. So they are basically distribution statistics developed by some shrewd people. So it's better you avoid such stories, go in for a good advisor, do your own research. I think that is it. And anything and everything you do with stocks has a perceived level of risk depending on the kind of stock you or business you are going in for. So nothing is sure shot and nothing is risk free. Be very clear about it.
Absolutely, nothing is sure shot. I think, Somil, you will also agree to this, right?
Of course, because it's absolutely a lie if somebody is telling you that they give you stock tips and it's sure short gains. It's absolutely a lie. Please don't get into these kind of setups and get into trouble. It's definitely a scam, probably. So stay away from these kind of things.
Absolutely. Nothing is sure shot, especially in the equity markets. For sure, nothing is sure shot. So please do not fall for such things as well. Be very careful. Do your own research as well before you actually get into anything. But let's move on to the next query. We have Shiv Jain, who's writing to us from Kolkata. He says that he is a new investor, wants to know what kind of return should one aim for when they're starting out. This is the first time they're investing. So what is it that they could look out for, Sharad?
Yeah, I think ideally just look for around 15% per annum, but that's also when you stagger it over a period of 5 years. So the compounded return, that simple compound interest formula, you should expect somewhere around 15%. That's a realistic expectation. And if you are a new investor, ideally you should go in for large cap oriented funds or, ETFs basically, so that your risk side is lower, so that in case volatility does come into the market, you are not unnerved by it because you are invested in top-notch stocks.
Absolutely. Somil, your advice to a new investor who's just entering the equity markets?
I think for the new investor, the first thing probably is to is capital preservation. When you aim for capital preservation, you'll start to get into large cap stocks, quality stocks. You'll start investing in quality stocks, dividend giving stocks, and all those. So I think that will be the first aim. And then once you get a little more experience, then you start trying to expect 8 to 10% returns annually. Probably after 5 to 10 years, you start getting a hang of it, and then you'll have a good knowledge about the markets. Then you can start expecting 12 to 15% of returns, that too annually, and after 5 to 6 years probably.
Okay, this next query is coming in from Chandigarh from Ridhima, and she's saying that she had heard that people should never expect more than 10 to 12% return from the market. She asks if that notion is true. What is your word on this? Sharad, you mentioned 12 to 15%. So I guess this is true what she's expecting, right?
Yeah. I think frontline investing, and the logic for this 10 to 12% that people tend to talk about is basically related to the nominal GDP growth, which is your GDP growth plus inflation. And generally in the longer cycle, what will happen is that at what rate companies grow, they would really align with the GDP growth. They can't grow beyond that as a wholesome game. So I think that is the logic why it is said. And I think it holds true in the long term. Maybe occasionally you have companies, the likes of the Nikas and the Zomatos, they can grow phenomenally, but it usually lasts for the initial 3, 4, 5 years maybe. And beyond that, that stagnation over a longer term, 5-10 year period, you will have that. So I think, it's logical to expect that kind of return on a diversified large cap portfolio.
Okay, that's about coming in from Sharad on the last query for today. So thank you so much, Somil, as well as Sharad, for joining in with us on the show and helping our viewers solve their specific queries related to the stock market, helping them understand how to invest better. Thank you so much for that, Sharad, as well as Somil. But with that, we are absolutely out of time on this edition of Your Stocks on CNBC TV18. Remember, you can always email us your queries and we'll address them with our experts. Up next, you will have Closing Well to take you through the last hour of trade and what's happening in the market.